It's a big day because Doug's debuting a new series for us. We're calling it Tax Tip Tuesday. Get to that in a moment. Very exciting. Okay, as I said, everybody thought today coming in the big thing was the New Hampshire primary, but I told them in the meeting, I said, no, it's Tax Tip Tuesday. It's our new series with Doug Flynn. That's what the big story is. So we're going to try this every Tuesday up till tax day. So give us your tip for today. I know it has something to do with IRAs, right? And
it does.
The timing of when you can put your money in, or tell us.
Yes, and so I thought we'd start with something that you can still do for last year. There's not a lot of things you can go back in time and do, and making an IRA contribution for the prior year is something you can actually do up until the time you file your taxes in April. And the big thing about this is that a Roth IRA, as you may know, is you do put in after-tax money, but it grows completely tax-free, so that one day when you take it out down the road, you have this big bucket of tax-free money that is fantastic. And so the amount you can put away is up to $6,500 if you're under 50 and $7,500 if you're 50 or over. And you have to have below certain income limits. You have to make less than $138,000 as a single person, or $218,000 if you're married filing jointly. But if you fit that, it's something you should seriously consider doing, because once you file, you've lost last year to make that contribution, and then you can work on this year, which you should do also. But I hate to lose a tax year if you haven't done it. It's quite substantial if you can grab that before you lose it.
Well, that is a good one though, right? Because I think a lot of people would think that it is, it's 2024. It's too late for this, but you're saying no. The timing
exactly.
You can look back.
I've had some people do, hey, let's do last year and this year if they had the money to do that with, to get that in there. And real quick math, if you just do $6,000 a year for 20 years, and just at 7 to 8%,
right,
you can amass over $250,000. And it's nice to have that tax-free. Look, you'll thank me 20 years from now if you have that you have this big bucket of tax-free money that they can't take away from.
I remember that guy on NewsNation. I really appreciate him. So we do appreciate you, Doug. Thank you, sir. We'll talk to you again soon, Doug Flynn, on that. And that's a new series. We'll have it every Tuesday from Doug. Tax Tip Tuesday. Tax Tip Tuesday with Doug Flynn between now and the 15th of April. Put it up on the screen here for a minute, the tips from Doug. I'll just do the first one to get you started. Beware of unexpected communication at the start of tax season that claims to be from the IRS. Take it from there.
Yeah, there's, millions of fraud cases are filed every year with the IRS, but specifically about 500,000 a year come in from ID theft. And so what happens is when the IRS only sends you letters via snail mail. They do not email you. They do not text. They do not contact you through Facebook Messenger. But people tend to get sucked into these things and give away their personal information, their social security number, their credit cards, and their bank info. And so the easiest thing to do is, if you get something weird and it's not by mail, it's likely not from the IRS. But the single biggest thing that people can do here to protect themselves is that you can sign up with the IRS. You go to irs.gov, the website, and just put in the search IP PIN. It stands for Identity Protection PIN. You can sign up for a 6-digit code that now only enables someone with that code to file your tax return or get information. There are a lot of cases where unscrupulous tax preparers will file a tax return for somebody before they actually file and take their refund. Now you can't do that if you don't have the PIN. And if you forget the PIN, there's a way to do it. So I strongly recommend everybody at least sign up for the IP PIN and avoid some of these things that can happen if you inadvertently give away some information that you shouldn't.
All right, good stuff as always. More on that next Tuesday, Tax Tip Tuesday with Doug, and we'll talk to you about the markets before then. Thank you, Doug. Final thing, it's Tuesday. So that means it's Tax Tip Tuesday with Doug Flynn. So today we are maximizing your refund. We can put up some of this on the screen as Doug takes us through it. How do we do it? How do we maximize our refunds?
Right. So the average refund was about $3,100 last year, and that was actually down from the year before. Now, you may very well get a little bit of a higher refund this year because the tax brackets went up by about 7%, meaning if you made less than 7% more than the year before, you likely are going to get a little bit more money back than you did before. But the real question is, if you're getting these refunds, is that a smart thing to do? Because think of it like this. The money that you just withheld from your paycheck in January, you're not going to get that back until next April. So you're giving that money to the government without any interest for like 15 months. And so the simplest thing you need to do is you can go onto the irs.gov website and go grab this form. It's a W-4 form. This is the same form that you filled out on the first day that you took your job, whatever the last job is that you took. And for many people, that might have been a long time ago. And maybe you have a different status right now. Maybe you're married and you were single when you started, but your withholding is off. And the real issue is if you're getting a $3,100 refund every single year, if you took that money and got it in your paycheck, and in step 4, you can just change your withholding to have them take out less to send to the government. You could invest that money. If you invested that money for 20 years, you'd have about $150,000. And so that's one way to do it. If you end up getting a refund every year. It actually also works in the reverse. There are a lot of people who owe, and they unexpectedly have to borrow money to do that. And so that same W-4 form can work the other way. For example, if you owe $1,500 every year, you can just fill in, take out that $1,500 throughout the year, and they'll just simply withhold an extra $30 a week. And now you won't owe anything. So if you're getting these wild fluctuating things, of course, if you're getting big refunds, don't give that money to the government with no interest. Get it in your hands each week, invest it, do something more productive. Even in a money market of 5%, it's more than giving it to the government at 0.
Very interesting news you could use. Again, we love Tax Tip Tuesday for that reason. See how easy appearing on the show is, Doug, if you don't just make openly hypocritical statements that you know are not true, and you could speak and we don't interrupt you or anything. Thank you, Doug.
Thank you.
All right, Doug Flynn. Tuesday for Doug Flynn's Tax Tip Tuesday. So, all right, let's talk about this. So our audience is all over it. They're learning a lot every week from the great Doug Flynn. What do we learn this week? What's the tip?
So today I wanted to talk about people who either are self-employed or have their own business, or even I'm getting a lot of questions from clients if they have a side hustle. So it's like money that you might earn with a 1099 income, you drive an Uber or whatever you do on the side. Anything that's self-employment income, you can do a special kind of retirement plan. And so, the first one to think about is called a SEP. Okay. It's called a SEP IRA. And so that stands for Simplified Employee Pension. And so basically what that means is if you take your gross earnings from your side hustle or your self-employment, and then you take your expenses, you can take about 20% of that and put it away into a retirement plan. And the best part about this type of retirement plan is that you can actually go back and do it for 2023 still. You can do it up until the time you file in April, or if you file an extension, you could actually do this all the way to October. And so it's one of the few things that a lot of people file extensions, and they might want to save a little more money on taxes. They have more time to put money away into a SEP. And so that's the first thing you want to look at in any of your self-employment income.
Yeah,
and then you can graduate.
Yeah, it's different than people who are working as salaried employees and things like that. So SEP is the word to know this year. It's kind of the word of the day or the word of the year if you're self-employed.
It is.
A lot of people do have these side hustles.
They do, and it's an expanded version. It's on top of what you're doing at your 401k. It's on top of what you might be doing in your IRA, and you get a much higher contribution limit and save some money on taxes. And then if you have a couple of employees, because the SEP doesn't allow you to really do it for employees, and if you do, you have to match the same percentage. So a lot of people don't want to do a SEP if they have employees. You can do a simple, and the whole point of the simple is a very inexpensive sort of 401k light, if you will. It is a lower allocation that you can put away, about $16,000 a year instead of the higher limits on a 401. You do a small match. It's very inexpensive to administer. So people that have a few employees and want to compete with other companies that have 401k plans, a lot of times they lose employees because their competitor has a retirement plan. So you can look to setting up a simple. Those are two of the first ones you want to look at. Okay. And then you can graduate into a single K or a solo K. And so that's, if you're a single person, again, you have to set this up for this year. You can't go back, but it has all the same high contribution levels of a 401k, but you can't have any employees. And so it gives you a much higher contribution level at a smaller amount. So quickly, if you make $20,000 from your side business, you could actually put it all away into the single K. With a SEP, you can only put away about $4,000. So a lot of people like the single K. And that's,
you could see why. That makes a lot of sense. So
exactly.
Is that the last? That's the last point then, though, on that.
The only other one, yeah, is then a traditional 401k for companies that have more employees and are willing to spend money on a third-party administrator and spend a couple $1,000s a year. Then you get into a real formal 401k like the big companies have. But these other ones you can do as a small business or a 1099, and the SEP is the easiest one to do for last year. But there are things to look at because you could save a lot of money if you have that side money and you want to put it away. Because I always say if you sacrifice a little bit now, then you can, if you live below your means now, you can live above later on.
Right.
If you're gonna live above your means now, you're gonna live below it later on.
That's it. That's the key to the whole thing. It's harder to, easier said than done, as they say, for a lot of people. But if you can do it, you'll be happy later on. Doug Flynn is always very good, and a terrific Tax Tip Tuesday. We'll see you soon. We'll have more tax tips next Tuesday. This hour, new information. It is Tuesday, so that means I brought my cards here. It's Tax Tip Tuesday with Doug Flynn. So we're doing this up until tax day. So let me bring up the first screen on Tax Tip Tuesday. We're going to talk about itemized deductions. Take it away, Doug.
Yeah, so right now, when most people file their taxes, they take the standard deduction, and that's up to 90% of all filers take the standard deduction. This goes back to a couple of years ago when they said we're going to make it really easy for everybody to file. They increased the deduction quite a lot, so a lot of people just take it. But if you're in that 10%, and I do think that that 10% could be a larger percent that itemize, because just as a quick example, those deductions on the standard are about $13,850 as a single person. It's about $27,700 if you're married. But if you itemize and you can get more deductions by detailing it, you could take the itemized deduction. So, for example, new homeowners, people that just took out a $400,000 mortgage at maybe 7% as an example lately, the first year you're at about $28,000 of interest. Now, that's only in the last couple of years. So a lot of people that were taking the standard deduction a couple of years ago might very well be looking at taking the itemized deductions, because it's not only mortgage interest, but it's mortgage insurance premiums, it's state and local taxes up to the cap, medical, charity, all that you bundle together. And so the quick tip is, if that math equals more than the standard deduction you would take, take a look, run both, run the standard versus the itemized, see if you qualify. Even if you haven't in the past, you very well might now, especially if you're in that situation with being a homeowner of late.
I think that's a really good point that you make, even if you have it in the past, because people, they get so used to doing things the same every year. You know what? Just take a look, talk to somebody like you, and maybe it makes sense. And if it does, give it a try. Thank you, Doug. Tax Tip Tuesday with Doug Flynn. We'll see you tomorrow with more business news. Because it's Tuesday, and that means it's Doug Flynn's Tax Tip Tuesday. And these segments are always interesting for, I think, viewers. They learn a lot from them, quite frankly. So today, you're talking, I think, about when you're selling something, you're selling a stock, you're selling a bond, there's a few different ways you can go about it, right? So take it from there.
Yeah, exactly. And so the first thing you have to pay a lot of attention to is whether or not this is a short-term or a long-term hold of the investment. So short-term is 1 year or less if you bought it 1 year or less ago and then you sell it for a gain. Long-term gains kick in when it's longer than a year. And it's really important because there's significant tax differences. So paying attention to that is really important. And you need to know what you paid for it and what you sold it for. And then that all goes on your Form 1040 Schedule D, which some people are filling out now. But if you're selling now, it's going to be for next year. But once you do that, this is where it gets kind of interesting. There's really 4 methods that you can use to report what you sold. You can use what's called first in, first out, which is FIFO, last in, first out, specific share identification, and an average cost. So let me give you a quick example. If you bought Bitcoin at like 3 different prices, let's say you bought it at 20,000, you bought it at 60,000, and you bought it at 40,000. So you have these 3 specific things. And now it's at 57, and you want to sell some. If you just sell it, they're going to default to the first one you bought, which was the $20,000 price. You're going to have a very big gain. And so what you might do is go to the specific share identification bucket, which was that $60,000 bucket, and you need to tell your accountant or put it on the tax return that you're specifically identifying those shares. Otherwise, the default is going to be probably not in your benefit.
But if you do that, a lot of people miss that. They probably do. But if you do that right, then you get the different cost basis, right?
You do. Then you, in that case, in that example, if you could sell the same thing you want to sell, but you're selling the $60,000 bucket for a tax loss today, but otherwise it might just report it as a huge gain off of the $20,000 or even the $40,000 price of the other buckets that you bought. So don't just sell it and take the report that you get from your broker or your mutual fund family and say, hey, here it is. Your accountant's just going to take that number, put on there. You need to know, hey, if some of these were bought high, I can identify and maybe pay less in taxes. And the real key is this: the difference in long-term gains, it's 0% for those that make below $47,000 as a single or $94,000 jointly, and it's only 15% up to $500,000. Where if it's short-term gains, that's ordinary income. So less than a year, you're going. I mean, the 22% tax bracket kicks in at 40-something thousand and 94,000 for married. So really important you pay attention to how long you hold it, and then identifying the buckets of whatever you're selling to get the most from it.
I don't think I oversold that at all. I think we actually did learn something again. As long as that's all legal, right, Doug? We're not breaking any laws or anything.
100% legal.
Okay,
100% legal.
Just making sure.
The only caveat is once you start with the particular method, you probably have to keep doing it. You can't kind of switch around at every turn.
No
That's
funny
the only
business.
thing.
We don't want any funny business on the taxes. All right, Doug, thank you. Tax Tip Tuesday with Doug Flynn. Speaking of talking about other things, everybody today's talking about the fact that it's Tuesday, not Super Tuesday, but Tax Tip Tuesday. You'd be surprised. You run into anybody on the street, and that's one of the first things that comes up. Doug Flynn's Tax Tip Tuesday. Forget about the politics. So today, we're actually looking at rental properties, right, which is interesting. So take us through this on the tax benefits if you're making income from a rental property and what people need to know.
Yeah, with the advent of homeownership getting harder, more people are renting, and boomers are the biggest 18% up increase in rentals. So if you want to invest in a way to capitalize on that or just own real estate, there's some significant tax breaks which we go through, and then talk about the ownership styles. But real quickly, there's a number of benefits that you get from ownership of real estate directly. The first one is some deductions that you don't get from your primary residence, like taxes and fees to manage the property. You can write that off. There's depreciation. You can actually take the value of the property and get an additional tax deduction based on a declining percentage of value that the property has, whether it's commercial or residential. That's humongous. If you have a $500,000 property, you're taking additional write-offs against your income. You also get the special capital gains tax treatment if you hold it more than a year. But you're also eligible for what's called a 1031 exchange. So sometimes people have a big gain in a property, and rather than sell it, they want to exchange it to something else and continue that deferral. You can do that. There's not a lot of investments that you continue to do that with, but this one you can. You also get, like any side business or side hustle, you have to pay FICA tax and self-employment tax on those earnings. That's excluded for rental income. It's not subject to the self-employment tax. So another huge savings there. And lastly, there's opportunity zones set up around the United States by the government. You get significant tax advantages for investing in those to help those areas, not the least of which is if you hold that property and have a big gain after 10 years, it's waived. You don't have to pay the taxes on the gain. So some good benefits to owning real estate. And then we could talk about the different ways you can own it. I think it's really important that people understand how you can also own it if you have a second.
All right, go ahead real quick on that, and then we'll wrap it up.
So direct ownership, of course, but if you don't have that individually, you could team up with friends and family. And there's a company out there called Nestment, and you can find them at nestment.com. They're into the co-buying. That's a way to easily do it. They connect you with people to make that very, very easy, because all those breaks really come from direct ownership. The other ways you can invest in real estate through real estate investment trusts, there are some benefits, but not quite as good. There's some income benefits, but direct ownership really is the key. And you want to have this in addition to your stocks and your bonds and your cash and everything else. So it's an important part of the portfolio. Diversify it.
Great advice as always. We always learn something from Professor Doug Flynn, so thank you. Rental income, the seminar today. We'll talk to you again tomorrow. Thank you, Doug, on all the business news. You know, let's talk with you. We do every Tuesday. Doug comes up with what we call Tax Tip Tuesday with Doug Flynn, and doing this up until tax day. So today, this is interesting because it affects a lot of people. The 529s, a lot of parents out there are using them to plan for college. This obviously has tax implications. Take us through it.
Yeah, there's two new benefits for this year, but just the old line benefits, which we shouldn't forget about, are, it's a tax advantaged way to save for college. And a $200,000 college today, if you had a newborn in 18 years, and that's the total cost for 4 years, is going to be $2/3 So you need to get on this. But some of the big benefits are there's 41 states that have a state income tax, and 38 of them offer a state tax credit or deduction for putting money into the 529. So there's a distinct advantage and a tax savings for doing that. You also get the tax deferred growth on the money. And then if you take the money out for college, it's tax-free, 100% tax-free. So if you're going to save for college, it's a great way to do that. You can also transfer money tax-free between beneficiaries if one child doesn't need as much and you want to shift it to another. And some other really interesting benefits are that we should all have this problem. If we wanted to superfund $18,000 per person per year, 5 years worth. So if you and your wife had $180,000 lying around and wanted to drop it into the 529, there's no gift tax ramifications to do that. Okay. And you can really superfund that. You can't gift for 5 years, but that's a huge jump for those people that had more than the annual limits. And another thing is people sometimes ask me, what if my kid gets a scholarship? And well, you're allowed to take that money back out for academic or sports scholarships, so it doesn't get stuck in there.
Right.
If you do save and then your child gets a scholarship.
Really good point.
So don't let the scholarship idea stop you from putting money away.
So you get a full ride for one reason or another, which is great news. This is not something that's going to be held against you. I like the fact that you get shifted between the children, right? Because it's not Doug's being nice, but if one kid's annoying you one day, just give all the money to the other kid. The other part about this, your own savings, I think we can put this up on the screen, can convert the unused portion to a Roth IRA. There it is. There's a limit, 35 grand. Talk to us about this.
This is awesome. These are two new benefits for this calendar year. And so if you do have excess money in the 529, the beneficiary, that is, can convert that up to $35,000 over their lifetime into a Roth IRA and continue that tax-free growth. And so real quick, at that age, $35,000 invested for 35 years, even at 8%, is over $500,000 tax-free. So you want to take advantage of that, even if you have some excess money in there. And a big change this year for financial aid was money that grandparents used to give you for your kids' college, if you had that situation, counted against you for financial aid. Now that's excluded. So in the old days, grandparents were just giving money to the parents to put in their 529. What you want to do now is have the grandparents set up their own grandparent 529 for the child, put money away, and then when that money comes out, if the rules are the same, it's as if it doesn't exist against qualifying for financial aid. So a huge benefit in the 2 new years. And so, like many things, not many people have said to me, oh, I'm really mad I saved too much money in my kid's 529. So, we should do that.
Thank you, Doug. News you can use. Doug Flynn, Tax Tip Tuesday. Thank you, sir. We'll see you tomorrow. All right. That reminds me of your Tax Tip Tuesday, Doug, because our audience is so used to these great tips, they expect to not even pay any taxes. So whatever you say now, they're just going to be, you've set the bar too high. So anyway, this week, let's bring up the first screen, and Doug will walk us through this. This is to help the older people, right? Essentially, you got penalties for people while they're working, while they're collecting Social Security. Start at the top and take us through it if you can here. What are you talking about?
Essentially, we have to know that with the baby boomers hitting age 65, there's 11,000 people in America every day turning 65. I get a lot of questions on, how does Social Security get taxed? How does it work? And the first thing you have to know is if you're not of your full retirement age, which you should look up what it is, and you decide to work a little bit, they'll actually penalize you and take some of your Social Security back. So moving that aside for a moment, because it's really important that you know whether or not you're going to keep all your Social Security, at some point when you do collect it, you may very well end up paying tax on it. And it's really interesting because you think about it, you put all that money in off your paycheck every week, with after-tax money, by the way, and now when you finally collect, they want to tax you on the Social Security income as well.
Doesn't seem fair.
And so there's a form. Yeah, it doesn't. And there's a formula that it's kind of screwy, but what happens is you take this combined income formula and you have to add back in tax-free interest. By the way, that's tax-free, you're not paying income tax on it, but they want to add that back in to determine whether or not they're going to tax you on your Social Security. And then depending on how much you make, that will determine whether half or 85% of your Social Security is taxed. And then, oh, by the way, there's about a dozen states who also tax you as well at the state level. So you have to know, am I being penalized? Am I going to be taxed on it? And then how can I get around that? And one of the best ways really to get around it is to look back to the Roth IRA, because at the end of the day, Roth IRA distributions are not considered non-taxable interest. They're non-taxable distributions. They don't count against you on whether or not your Social Security is going to get taxed. And so I'd look into that. And also, if you have the ability to put money away into the Roth or do some conversions of old tax-deferred IRAs into Roths, those are taxable. You have to watch. But whether or not it makes sense to pay a little bit of tax now to avoid all these other taxes on what you've worked for. I'll never forget when you first get your paycheck and you're like, who's FICA? Why are they taking so much of my income every week? And now, oh, by the way, they're going to tax you on the way out as well.
President Biden, sorry, Doug, I was just looking at this while you were talking, and saving us a lot of money, just arrived in Vegas. These are live pictures, by the way. Remember, we told you he's campaigning in Nevada today, head to Arizona tonight. So it's good stuff, Doug, always is. Thank you for saving everybody a lot of money on their taxes and exposing the screwy government for these rules and trying to tax us. Like, I'll remind you, it's the same government, as we reported earlier in the show, that currently employs 77 dolphins. So I don't know if that gives you any perspective on all this. Oh, my goodness. All right, thank you, Doug. Doug Flynn with us today. So Claudine, who's behind the glass over there and is in charge of the show, told me we didn't have enough time for your tax tips, but now she feels bad. And she says, Doug, give us your best tax tip in 30 seconds. So go ahead. The audience is demanding it. Tax Tip Tuesday.
The best tax tip is look at tax-free municipal bonds relative to taxable bonds. So many people are focused on what they get. It's not always about what you get, it's about what you keep. And the yields on some of these tax-free bonds, especially if you're in a 24% tax bracket or higher, could end up rivaling and even surpassing what you're getting on the taxable side. And it's keeping more for yourself. So take a look at that. That saves you some money on taxes, which in the end means that you'll have more money.
Take that, Larry Fink. That's better. All right, Doug, thank you, my friend. Doug Flynn on all of that today.
It's Tuesday. That means you have some tax tips for us. Take it away, sir.
Yes, so this is interesting for people who are putting away money towards their retirement accounts, and there's something called the Retirement Savings Contributions Credit. It's shortened to the Savers Credit, but it's an often overlooked credit that people should look into. And of course, you have to qualify. You have to be 18. You can't be a dependent on someone else's return, and you can't be a student. But if you meet that requirement, then the next thing you take a look at is the credit that's allowable based on whether you're a single person, and that's $1,000 is eligible there, or if you're married filing jointly, you have $2,000 of a credit that you can get. And this is against even IRA contributions, even Roth IRA contributions, and of course, employer contributions to your 401k or 403b. But if you're making those contributions, then you just have to make less than a certain amount in order to get a percentage of what you put away back in a credit.
Great.
And the best thing about a credit, as you know, is a credit is a dollar for dollar offset against your tax, unlike a deduction, which just lowers the amount that you pay tax on. And so if you meet this requirement, I've had people who changed jobs or they retired and they worked half a year, or you're just starting, but they are saving into retirement, and they're eligible for this credit. So basically, even if it's a small amount, it's free money. You should make sure you look into it, or make sure your accountant searches for that in there and see if you're eligible. And you can do this before you file your taxes if you haven't already done so.
Great advice. Talk to your accountant. Do some research.
Okay, this is it, by the way. We should have brought tissues. We'll wipe a tear away from our eyes. This is the finale, the last edition of Doug's Tax Tip Tuesday. I mean, tax day is next week, right? April 15th is coming up. So this week, let's put up the first screen that you have, because you're talking about changing ownership on a home or an investment account, I believe. So take it, there it goes. Be careful when you're doing so, it says here. Take it from there.
That's right. And people come to me all the time and say, I just put my kid on my deed, or the kids say, my parents just added me to the house. And I'm like, whoa, 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 whoa. If you inherit a house through someone's passing, like if your parents pass, you inherit the house, you get what's called a step up in basis, and there's no income tax due. When they put you on the deed, it goes all the way back to the original date of purchase. as if you bought it. So they think they're doing a good thing, and they've actually transferred the original cost that mom and dad paid for the house a million years ago. That's probably highly inflated, and now you won't get that step up, and when they go to sell the house, they have to pay all those taxes. And a lot of people have no idea that this happens until it's too late, and they go to sell and they have to pay all that income tax.
Other
So just be
reasons,
very
though,
careful.
right, to have there would be other reasons on Medicare and things like that, trusts, where you could make the case for doing something like that, or no, you don't ever think it's a good idea?
It's almost never a good idea, but really a trust can solve all those things. The goal is very valid. I want my kids to inherit it and keep it out of Medicaid. You can do all those things with a trust. People just tend to just put them on the deed and not do the trust.
Without the trust,
it's probably worth
I see.
So if you have a trust,
you're good, but if you don't, you're not. So, okay, so did we do this taxes on earnings first for withdrawals from annuities that are typically bought, I guess or is that the third one? I think the other one was on bonds.
That's the third one.
Okay, bonds. So these, understand how interest works on the bonds, right, was the other one that you had.
Right. So you have double E bonds, and then you have the I bonds. If you remember 2 years ago, everyone got all excited that it was paying 9-point-some-odd% on the I bonds. And by the way, that renewal rate that'll happen next month is probably going to be in the 3+% range. So you have to understand how the interest rates work on these bonds. But a lot of people choose to defer the interest. You can. That's what most people do. And what that means when you defer the interest is at some point, someone has to pay that interest.
Oh, okay.
And so sometimes parents are buying these bonds in the child's name. The kids don't even know because they're deferring the interest. The parent passes away. The kid inherits all these bonds. They go to cash them in. And once again, they have to pay all this tax on all this interest at a time when they're probably in their prime earning years. The parent might not have been in their prime earning years when they were doing this. So a good idea, but in the end, not such a good idea. There are better ways to do that.
I think we have to rush through the annuities one. I'm sorry about that. I was out of order there for a minute. So wrap it up
problem.
for us.
Long story short, annuities often have a teaser rate. You go into the bank and the person says, hey, you can get 6%. By the way, it's probably only 18 months, and then it drops to 3%. Same idea, tax deferral. Great investments to live with, no taxes while you're there. But oftentimes when the kids inherit these annuities, they're deferred. They have to pay all the income tax on all that earned interest that the parents might have been better off paying in a lower bracket. It happens all the time. So just be very careful. You understand how annuities work when you buy them, and oftentimes you're locked up for a period of time, even though the interest rate drops.
I'm already getting upset thinking about next Tuesday and what it's going to be like without our tax tips. But this has been great, though, Doug. Seriously, I think a lot of people learned a lot and saved a lot of people a lot of pain and agony and more importantly, money. So good stuff. Good series.
Excellent.
Doug Flynn.